Now that we've got our EBITDA, or earnings before interest, taxes, depreciation and amortization, what we want to do is figure out what our earnings is after interest, taxes, depreciation and amortization.
We're going to throw in our last couple of assumptions about like interest rate and capital expenditure. Knowing how this stuff works, even though it's boring, is the difference between somebody who makes something nice and sells it and somebody who knows how to run a business.
You can think about startup expenses that you might have and ongoing expenses. Startup expenses might be lawyers' fees and accountants' fees for getting all the structures you need set up. You're going to need to incorporate your company. You might need to get advice about the types of insurance you need. You might have to pay an accountant to help you set up your financial statement ledgers to keep your accounting straight. So sometimes there are upfront setup costs that are one-off, and you need to make sure you account for those upfront as distinct from your ongoing operating costs. Interest is broken down into interest income that you might have. For example, if I've got cash sitting in the bank, that's paying interest, although in Australia at the moment we're not getting very much of it. That's interest income. You might not have any interest expense, but if you've borrowed money to set up your business or to run your business, or if you've leased equipment, you will have interest expense. So the interest line item can either be positive income, which can add to your bottom line profit, or it can be a negative expense at the end of the day.
One annoying thing about interest is that banks are very good at making money. And the way that they do it is that if they lend you money, they lend it at a really high interest rate. If you give them your money and leave it in a bank account, they give you a very low interest rate back. So you might only make 2 or 3% on cash in the bank. Whereas if you are borrowing money, you are going to have to pay the bank an interest that might be a lot higher than that. So if our net interest is negative, the percentage on that interest is probably going to be much higher.
Pretty easy. If you've got more income than expense, you've got something that adds to your profit. If you've got more expense than income, you've got something that detracts from your profit. So after interest, we need to figure out our depreciation and amortization. And this can be a little bit tricky. Depreciation refers to how I account for certain capital costs that are tangible in nature, like the camera used to film this video or the oven used to bake my muffins. And amortization refers to intangible assets like trademarks or intellectual property or goodwill. Chances are when you're starting out your business, you won't have any amortization to worry about. Depreciation is a non-cash expense that the ATO lets you count as an expense to lower your taxable income. Why depreciation expense is good is because it lowers your taxable income. So at the end of the day, I pay less tax. And for a business, obviously, the less tax you pay, the more profit that goes into your pocket. In my operating expenses, I know that oven is going to last me for 10 years. So I might depreciate that oven over a 10-year basis. So I can depreciate $100 each year over 10 years. But basically what depreciation is for all my capital items, what is the useful life, and therefore how much of it is going to be used up in each year that I'm operating my business. We start out with EBITDA. We've now figured out what our interest expense or income is. We figured out what depreciation and amortization is. So we've got profit before tax. So your profit before tax is not quite what you take home at the end of the day because the ATO wants a piece of that.
Company tax rates are generally a single percentage that changes country to country. So it's like, I think it's 40% in America, 30% in Australia, and 0% in the Cayman Islands and other tax havens. Income tax, however, like personal income, is generally bracketed. So the more money you make, the more you are taxed. Let's say you're a single person business that makes $100,000 in a year. Should you have a $100,000 wage or $0 in wage and $100,000 in company income? In Australia, 30% tax on the company income would be $30,000. Whereas $100,000 taxed against personal income is like 25% in tax. So if we were to take the same amount of money and class it as company income or personal income, you get a different tax rate. which is a saving of about $5,000. What if you earn like $500,000 in 1 year? If that was taxed at the company tax rate of 30%, you would pay $150K in tax. However, if that $500,000 was a personal income, the tax rate gets really high, and you'd actually pay like almost $200K in tax. So in that example, it's actually smarter to have a big chunk of that income as company tax, not personal tax. Now, a good accountant will help you manage that income between personal and company tax. And either way, paying tax is a really good thing because it means you're making bank.
So after you've figured out your tax, you deduct your tax from your profit before tax, and you get your net profit at the end of the day. It might be that your business doesn't make money for the first 3 years. If you're only looking at a 3-year time horizon, you might say that business doesn't make a lot of sense. But if you're looking at a much longer time horizon, if your revenue will increase exponentially relative to your costs going forward, then you might have a profitable business down the track. Now, your net profit is a little bit different from your cash flow because, as we've discussed, there are certain expenses that don't really represent cash out of your pocket for a particular period of time. Depreciation and amortization is your major non-cash expense. So to understand your cash flow, you need to add back the non-cash items that got you to the point. Well, this bit's important to understand, so not only figure out your profit at the end of the day, but also your cash flow at the end of the day. And cash flow is critical. Often people say cash flow is king.
Especially when a business is just getting started, it's like really fragile. If you have that one customer pay you late and get a big tax bill and get like a bunch of super payments for your employees, you can suddenly need to pay $20,000 or $30,000. If you don't have that money in the bank, you're looking down the barrel at a $20,000 expense and you won't have any money to pay your employees. If you can't pay your employees, they don't stick around and you can't make the money to pay off that debt. This is what makes a business collapse.
If you run out of cash, you can't keep running your business. You'll go insolvent. So you need to make sure you've got enough cash to keep running the business, and you need to make sure that if there are periods in time when you have negative cash flow, that you've got sufficient cash to see you through those periods of time.
Okay, we've dealt with some of the annoying and confusing parts of this template. CapEx is the money that we put into the business to start it. Depreciation is like stuff becoming less valuable over time. Tax is all the money that we give to the government. Then we've got net profit, and the cash flow is the money that we actually get to take home and spend on stuff.
The real power of the model is that you can change the assumptions and see how sensitive your bottom line is to changes in the volume of how much you sell, changes in how much you charge for something, or how much it costs you for various line items. You'll get to understand how sensitive your bottom line is to changes in those assumptions. So before you set up your business, you want to keep iterating and improving your model until you think it's as accurate as it can possibly be based on all the information you know. You might not have all the answers, but now you know the questions you need to ask to get those answers. If you don't know what certain operating costs will be, you know what you've got to do to figure it out. You can figure out who the people are you've got to talk to. You know you can potentially go online and do some reference checking and some searches. You can go talk to potential customers to understand their experience. There's a great sense of achievement when you've actually built a model and it works really well. That really functions and tells the story of your business. Before you set up a business, you will need that model, and having an accurate, robust, viable model gives you the confidence you need that your business actually makes a lot of sense.